Do you often wonder, is the market overvalued, undervalued, or priced just about right? As we conclude this series on market valuation, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. The idea behind market valuation is to take a big picture look to see, is the market fairly priced, or is it expensive, or is it cheap? This is part 7 and the final part of this series. From this point forward, I will make updated videos available as the model changes. I look at the model about once a week, and if there are any changes, I'll be sure to note them and post an updated video. What we're doing is we use tools to try to determine if the market is overvalued or expensive, undervalued, meaning cheap, or priced just about right or fairly valued. The website that I'm using to get most of this information is called Current Market Valuation, and posted here is their web address, and I also include this in the description below. What I'm going to do in this particular video, instead of breaking each model down one piece at a time, I'm going to put the entire model together. Current market valuation uses 5 different models to provide valuation that's relative to the long-term historical patterns as well as fundamental indicators. And if you don't understand that, go back and watch the other videos where I break each model down and explain what is going into that model and the information that we get from that model. The first model is the yield curve model. Then we look at the Buffett indicator model. Next is the PE ratio model. Number 4 is the S&P 500 mean reversion model. And finally, number 5 is the interest rate model. Going to currentmarketvaluation.com, this is what is posted as of the recording of this video. Currently, as of September 17th, 2021, when you take all of the models together, they average a 1.8 standard deviations above, indicating that the S&P 500 is overvalued. It's not extremely overvalued, although some of the models do show that. It's not fairly priced, even though some of the models do show that. None of the models are showing that we are undervalued at this time. The first model that we look at is the yield curve model, and that is fairly valued. We can look at the chart on the screen and look way over on the right-hand side. The last time this was updated was August 31st of 2021. The yield curve is now at an average spread, but recently inverted, followed by the 2020 recession. I also have other videos that talk about the inverted yield curve. But looking at this chart, we're just a little bit above the historical average. We're not too high to the upside. We have not hit the +1 standard deviation. This has a little room to rise before it gives us some kind of an extreme reading. One of the reasons why this model is fairly valued is because interest rates are so low. A lot of investors, they don't like the returns that they're getting in the bond market, so they're willing to take on more risk in order to get better returns. The stock market is doing really well. In fact, it's considered to be very overvalued and has pretty much gone parabolic for the last few weeks. Whether that's going to continue or not, We use other measurement tools to try to decide that. Next, we look at the Buffett indicator model, and it is strongly overvalued. What we're looking at here is where is the value of the S&P 500 over on the right-hand side in relation to the exponential trend line, which shows the average GDP ratio of 120% to be fairly valued. The S&P values are way far away from where they should be, and this line tends to act like a magnet. So at some point, not necessarily immediately, prices will either have to come down or this line will really have to go up a lot faster. We've been in this situation for almost a year. The last time this model changed its rating was November of 2020. I'm recording this in September of 2021. The next model is the PE ratio model, and I have a number of different videos that talk about the PE ratio and where we are at with that. This is one interpretation and one way that you can use the PE ratio. Over on the right-hand side, as of September 17th, 2021, we are 90% above, according to the detrended chart, above where we should be. The historical average is placed here at 0, and we are way above that. Just like with the previous chart, something has to give. Either prices have to come down or the historical average will need to go up. The last time this model was updated was March of 2021. The next model is the S&P 500 mean reversion model. This also measures how far away is the S&P 500 from historical prices. As of September 17th, 2021, we are 85% above the trend line. That is really far. When you compare it to what has happened in the past, we are showing an extreme reading. Now, is this going to change overnight? Not necessarily. It's been showing this reading for quite some time, and it may continue into the future. We may experience some kind of a pullback in the market, which might help these values become more realistic, but right now they're just almost off the charts. The last time this model was updated was April of 2021. So you can see that all of these models, they don't change very often. That's why I don't post a lot of videos about this, only when something really changes. Then we look at the interest rate model, and because bonds are going up and interest rates are so low historically, current market valuation has them placed at fairly valued. We look over on the right-hand side, with the S&P closing at 4433, this is 2.4 standard deviations above the trend line, which is pretty extreme, and that's a little hard to see because of the box on this chart. Looking down below on the right-hand side, the 10-year Treasury rates are at 1.3%, and they are 1.5 standard deviations below the trend line. So stocks are very overpriced. Bonds on a historical basis are very underpriced. When you take the two of them together, you come up with the purple line, and we're just below 1 standard deviation right now. That means that we are fairly valued. As long as we stay in the +1 above and the -1 below, that's the fair value area. Once we go above that, we will get into overvalued territory, but we're not there yet. And this particular chart is updated on a weekly basis, and it was last updated on September 17th, 2021. So what is the conclusion that we can make? It's pretty much the same conclusion that I've been making throughout these other videos. The S&P 500 valuation model, this posted by Current Market Valuation, is overvalued. Some of the models that we look at are very overvalued. Some of them are fairly priced. When you take the two of them together, you come up with an overvalued situation. However, there's really no immediate action that we need to do. We need to be aware of this, and we need to be prepared if things really start to turn. But this can go on for an extended period of time. It's already gone on for quite a while. We don't know how much longer this will last. We use other tools to help us measure those things. But based on this model, we just look at this to understand the current environment that we are in. However, it is necessary to have a plan that needs to be developed now. This is the fall of 2021. We're coming into a historically weak time for the stock market. Now, there's been other times when we've gone through this period of time in October and have done just fine. But a lot of times when the market really starts to break down, it ends up being in October. We use other tools to help evaluate that. But I'll just say, things that I'm looking at don't really show that we're in all that bad a shape, even though we're not as strong as you would think we would be right now. The idea is to sit down and make a plan when things are going right. Because there will come a day when things turn and start to go against those people that only make money when the market goes up. You have that plan developed, you have it ready to go. And then if the market environment changes, you know what you're going to do, but you need to plan for that now. If other measurement tools that we use suggest that there's a major change in trend from up to down, and yes, as I record this, we've seen some short-term weakness, whether that's going to develop into stronger weakness, we're not sure at this point. There's a lot of evidence to suggest that we might be doing a regular pullback before we get set to go higher. There's other people out there that think the end of the world is right on the horizon. The idea is to use this tool and other tools to get an overall view of the market and then develop that plan. If you are in long positions, you will become more defensive if things turn negative. You'll get rid of those stocks that are more risky. You'll get rid of those stocks that really maybe have performed well but are starting to show some weakness. You may get into other stocks that tend to do well during market declines. If you do these types of things, you are considered to be more defensive. You may also implement some kind of hedging just to protect yourself. You've enjoyed some nice gains and you want to keep those gains, so you use options to protect your portfolio so that you're not making any money during that time, but you may not be losing much, if any, money during that time either. This hedging protection does cost money and it does bite into your returns. As the market has been going up, maybe you have not been applying any kind of hedging to your portfolio. If things start to look more dangerous, you might want to start doing that. If you are more short-term in your view and you don't have a problem with the market going down and you like to take advantage of that, there are instruments that you can use. We have inverse mutual funds, inverse ETFs. You can outright short stock if you want to do that. I don't recommend that. I teach what shorting is, but I don't personally recommend people doing that. I think there are other ways to do that that are a lot safer. But if you do participate to the downside, you become more offensive at that point. Or you might have a combination of the two. Part of your portfolio might become more defensive, where you may then jump into some opportunities where you are more offensive. None of this necessarily needs to be put into place at the time I record this in September of 2021. We just need to be ready in case things do change and either become more defensive or look for new opportunities to the downside. So thank you very much for taking the time to watch this video. I really do appreciate that. Please leave a like or dislike. Also, leave any comments. I really appreciate that as well. Consider subscribing to this channel. That'll really help things out. Please access the free workshop that I talked about at the beginning of this video. There is a public Facebook group that you can join. And I also have a blog, spxinvestingblog.com, where I have articles that pretty much mimic what I've been talking about in the videos that I post. So with that, thank you very much, and I'll talk to you in the next video.